Okay, welcome back, folks. Session 6 out of our 7 topics for today at this round-the-clock trader summer school. I'm Simon. Nice to see you. I can see a few more people just arriving during Adam's talk there. If you missed the talk, don't worry, it is recorded here. You can watch it once we're finished the live events today on this link, or you can go to the YouTube channel and you'll be able to watch it there as well. YouTube.com/IX Investor. So our next speaker, Sunil Mangwani, I'm delighted to have him here. He's helped me with these events many times before, a great speaker. So let's bring Sunil in, the founder of Forex123.com. As the name suggests, a master of the Fibonacci trading indicators, technical trading indicators. We sent the invite out, so just a couple of minutes, Sunil should be joining us. We do happen to have a problem. Sunil's already sent me a couple of his slides, so we can run them from my PC if we have any issues. But here we go. Let's see him. He's accepted and he's coming into the webinar, which is great. We've got an hour, 45, 50 minutes with Sunil, and then George Halmy from Click Events will be joining us at 3, taking us up to the end of 4. There we go. Sunil, nice to see you.
Hey, Simon, good to see you. How are you doing? Can you hear me? Is audio okay?
Okay. We're not
Yeah,
hearing.
no audio. Okay, one moment. Let me check my audio.
No, I think you just need to take your microphone. If you can hear me, Sunil, you need to move the mouse just above your picture, your video cam, and you toggle the mic to go from red to white. You see the little symbol of the microphone? Okay, don't panic. Yeah, if you're hovering your mouse, if you just hover it over your image on the webcam, some symbols will appear above it, some options. One of them is a symbol for a microphone, and if you click once and just give it a second, it should go from red to white, and then we should be able to hear you. Sounds like maybe the microphone's not picking up, that you've got the microphone plugged in. Perhaps you need to just unplug it and plug it back in so that it actually picks it up. Tell you what I'll do. Let's see if that, I can see that Sunil's plugged it back in. Okay, well, we've had other issues today, so we this is a new one. We'll just hold on. Don't panic, Sunil. We're all here. Mike, that's right. I can see it as well, and it's not something that I can override to take the microphone off for him. I'm afraid it has to be done from his end. Just not sure the system's reading the microphone that's plugged in. Might need to go into the audio settings. Perhaps Sunil, if you could just close the whole browser window, close the tab, and just log back in, and then that might pick up the audio, the video, the microphone. I think that might be the best thing to do. While you're doing that, I will bring up the slides.
Here we go. Are you okay now? Yeah. Can you hear me now? Can you hear me? No.
Oh, okay. I think we're there. Sunil, your
Can you hear
microphone's
me?
off.
This is going to be a problem. Can you hear me now?
Yes, there we are. We can hear you now.
Okay. I suppose I'll have to do without the mic, but is audio okay?
That's great. If you can hear me and I can hear you, and can everybody else hear?
Sounds good.
Okay, fantastic.
Okay.
Now, are you? I think I have your slides on here, so
Yeah.
you just let me know when you want me to change the slides.
Do you want me to do the presentation from here?
Well, you'd have to share your screen, but I think we'll probably let's just go with me.
Okay.
Yeah.
Just give me one moment, Adam. I think let me just adjust my mic settings. One moment. Simon, just give me a moment. Can you hear me?
I can hear you. Yeah. So just ready to go when you're ready, Sunil. I think we can, if we all just turn our speakers up a little bit, that will help. But we can hear you, we can see you,
All good.
and we can see the slides. So crucial factors of money management. Sunil Mangwani, where do you want to start? Because it's a while since we spoke.
It's been a while. Well, just as a little bit of background for people over here.
No, okay, we seem to have lost the sound again, Sunil.
Yep.
Is that maybe a loose connection or something, or maybe you need to bring the microphone closer?
Problem. Are we okay now?
That's better. Yeah, yeah, yeah.
Okay. All right. Okay, let's go right ahead. Yeah. All right, folks. Hello, everybody. Good to be back over here again. Always good to be back with Simon. It's always good presentations over here, good crowd, good audience, very interactive sessions that we have. I always enjoy coming over here. Before we start off, let me give you a little bit of background. So, I'm primarily a Forex trader. I've been trading the currency markets now for 20 years, a little over 20 years right now. Uh, but also gone into other markets, diversified into other markets, because the simple fact is that what works on one market will work on any market. The simple thing is any kind of chart patterns that we talk about, anything works with any instrument which exhibits some volatility, which has volatility, so it can work on anything. And we as traders need volatility. Okay, Simon, are we good on sound? We have a couple of people not hearing anything. Are we good on sound?
Yeah, I think I've turned my speaker up to full to hear you. So
Yeah,
you are coming through. If you can try and speak up a little bit, and everybody at home, if you can turn your speakers, your volume up.
it seems to be. I'm sorry, folks. It seems
Here
to
we
be
are.
that the audio
Yeah,
volumes are, the
it
settings are
is
a little
working.
bit.
It's just a faint signal. So if we turn our volume up at this end and you speak a little bit louder, I think we'll get there. I think we'll be okay. So
Okay.
thank you.
All right. All right. No, no issues. I'm just hoping that everybody can hear me properly. So, on my background, I started off like, and the reason why I wanted to go into risk management today was because of my own personal experience. I started trading like any other trader, started with technical analysis, bought some books, did some courses, studied every indicator, etc. Never really made money, wasn't really successful. It took me quite a lot of time till I realized what I was doing wrong. The first thing was indicators, which I used to follow like everybody else does. And it's not really a new trader's fault, because when a new trader comes into the market, most courses really talk about indicators. They really don't talk about anything else. So this trader does go the way what he says, or he or she says that this is the way to go. The first thing I did when I realized was I threw away all my indicators, went into price action completely. And the most important thing, I realized that if I change my risk management, my account has a better chance of growing, and which is exactly what happened. So, risk management is the most crucial factor that a trader can really think of, much more important than anything else. Okay, Simon, can we have the other slide, please? Mhm, mhm. Hello? Simon, can I change the slides? Yeah, thank you. Simon, is it possible for me to share the slides? Because it's going to be a problem for every time I have to ask
Yeah,
for them.
okay, well, Daniel, to do that, then you just need to hover your mouse again, and you'll see a small symbol of a laptop with
Yep,
an arrow.
yep, okay. I don't know. If I click on that, then it's not going back. So can you folks see my slide?
Yeah, we can't see your slide, I'm afraid. I don't see anything happening on the screen share. If we can,
Okay.
can I recommend we just continue with me controlling the slides since we have it?
Okay, all right. Okay, I'll have to just keep telling you about that. All
Yeah,
right, go ahead.
just let me know. Just a quick change slide and I'll be able to change it. Just takes a second or two. There's a little bit of a lag, but that's all.
Okay, all right. So I'm sorry, folks. Let's continue. So continuing with this, with risk management, and the simple fact is, ask any professional trader the secret to success, and they will mention risk management. It is the most important factor. But even within the factors of risk management, a lot of traders tend to give priority to different factors, like something like the win loss ratio. Simple fact is, having a large number of winning trades is beneficial to the account. Mm, I think we are having problems with the mic. A lot of people cannot really hear it. Mic volume is very. I'm sorry, folks, but Simon, could you just give me a moment? You know what I'm going to do is
Guys, you're just gonna have to stick with us. Sunil is very faint. I'm very loud, so I'm gonna not speak. But you need the volume up to hear Sunil. So there's no point in you know, we are where we are, I'm afraid. So we'll try our best to get through. Sunil, just carry on.
All right. How's the sound now? Is it better? Can you hear me? All right, folks. I think I'll have to just stick to this. Okay. All right. We will stick to this, and I'm going to stick my face right next to my laptop so that you can hear it. Something's gone wrong with my mic, and I'm sorry about that. But you'll have to just bear up with me in your face. All right. Okay. All right. So we was talking about risk management. So there are different factors of risk management also which really matter. Different factors in the sense you have different rules for risk management, different elements of risk management, but everything right now, or it can go down to risk management. The simple fact is that what I'm going to go over is that even the markets that you trade and the time frames that you trade on should ideally be decided by the factors of risk management and not by your comfort level, if that's the way you're talking. Next slide, Simon. So understanding these points will really help going over the important factors. Simon, next slide, please. Well, I'm going to go over this very quickly. The statistics say that almost 80 to 90% of the retail traders lose money. Now, when I'm talking about retail traders, I'm talking about individual traders like you and me, not institutes, not banks, not funds, not the big money. Retail traders, most of them tend to lose money. And research shows that more than 80% of them do lose, but there are a certain number of retail traders who do make money. Most retail traders really lose due to the significant risks involved, but there are some people who do make money. This requires an in depth understanding of how the markets work. And this is one of the factors that we are going to go over about how the market works. Next slide, please. So if there are a small number of retail traders, like the previous session, Adam talked about, you know, institutes, can they control the market, or the retail traders are dependent on this? Well, not really dependent on it, definitely, but there are some traders, retail traders. I know retail traders who are successful, who can make money. The fact is that most retail traders lose money for the simple reason that they do not follow the correct system. So when new traders start their trading journey, Most assume the way to success is to have a good trading system. Everybody concentrates upon a good trading system, an excellent trading technique, which is the holy grail of the market that they look for. But successful trading is not only having a trading system. It is a combination of various factors, which I describe as the three M's, which we'll go over. Unless you incorporate these concepts of three M's in your trading, the likelihood of success is very low. Next slide, please, Simon. Most retail traders have no concept about this, or either they don't understand it or they don't really follow it. So the three M's in terms of priority, I would put it, are money, mind, and method. So money simply means your risk management, your money management policies. Your mind factor, I put it down to simply patience and discipline. The method is the trading system that we talk about. Now, this trading system could be anything. It could be fundamental analysis, could be technical analysis. It really doesn't matter. What matters is the system. Now, if I distribute these three factors on a scale of 1 is to 10, the money part will take up 5 parts out of 10. The mind part will take up 3 parts out of 10. And the method takes up only 2 parts out of 10. Next slide, please. So you see, it is your method which is the least important part of your trading system.
Okay, I'm going to try and speak quietly.
Yep.
I think we have another issue with the sound, Sunil.
You cannot hear me?
I'm not hearing anything at all, I'm afraid. And Henry, Sachin is fine.
Audio seems to be working fine
Okay.
for some people. Can you hear me or you can't hear me?
Okay, we'll carry on there.
Okay. Next slide, please. Okay. Can you give me the next slide, please? And screen sharing. Simon? Simon, can we have the slides, please? We're gonna have problems today, big problems. All right, folks, can you see my screen and can you hear me? Oh, I can't see the chat box. That's the problem. Okay. All right. Simon, can you hear me? Simon, are you there? I'm going to go. Okay. I'm going to go with the screen and I'm going to go with the audio. If at all something happens in between, just give me a shout, please, because I can't see the chat. Would that be okay? All right. Okay. Here we go. All right. So we finished this one. All right. So we finished this slide. We were here. I was going over this one. So as you see, the method is the least important part of your trading. Now, while this does not really undermine the importance of the technical or fundamental analysis, the fact is that your techniques must be combined with other factors. Any new trader, amateur traders, novice traders, they usually do not understand this concept of the money and the mind, and they tend to concentrate only on the method. Within this method, these retail traders tend to use indicators more, most of the indicators which are lagging. And so a retail trader A novice trader who comes in, I would say, follows only zero point 0.5 parts out of 10. And then is it surprising that these traders fail? So my point has always been that you don't fail because you're not good at trading. You fail because you're not following the correct process. Once you understand the process and follow the correct process, the chances of success are definitely there, and it will put you in the top 10 to 15% of the traders. So let's start with the three M's. Let's start with money. This is what we're here to talk about, right? So, as traders, obviously, we are here to make money from the markets. But what should your priority be as a trader? Your priority as a trader is to conserve your capital. Now, I always say that as a trader, your first job is of a money manager. Second, you're a trader. Because the simple fact is that your capital is your bloodline. Obviously, without it, you cannot trade. So, preserving your capital becomes a matter of utmost importance. Now, losing trades, we all know, are a part of trading. Everybody knows that. So, controlling the losses becomes very crucial. Losses and wins are in the hands of the market. They're not in our hands, which is what I always say. But how do we control the losses based on different factors? That is what we can control. Now, a single loss, the importance of controlling your losses, because a single loss is not only a loss of capital, it also puts a trader two steps behind in the quest to your profitability. Now, mathematically, this is because the percentage gain needed to recover from a loss increases exponentially with every loss that you take. This is a simple graph. It's just simple mathematics. So if your loss of capital is, let's say, about 25%, you are going to require 33% to get back to break even. Let's take an example of 50%, right? Let's say I have an account of $10,000, just as an example, and I have lost 50% of my capital. So I'm left with $5,000. Now I have to make $5,000 on top of my existing 5,000 to get back to break even to my capital of 10,000. And then my profitability starts. So the larger your losses are, the more exponential is your path to recovery. Now, this is simple mathematics, but most traders do not think of this, or they just don't bother about these factors. So, this is something you have to keep in mind, that keeping your losses small is always the most crucial thing that a trader can do, right? So, conserving your trading capital, it's not just a simple process of keeping your risk limited. I cannot say that my risk is limited, so I'm controlling. You must have a set of money management rules which will help to grow the account in spite of having losing trades. Now, there are two very simple and basic rules of risk management that can increase your success ratio, which I refer to as the two golden rules of risk management. The simple fact is, if you follow these two golden rules, it will help you put you in the bracket of the top 10 to 15% of the traders. These two golden rules, now this is part of our courses, of course, but this is what I want every trader to have a look at. Everybody knows this. In fact, even in the last session, Adam talked about both of these: risk to reward ratio and correct position sizing. Every trader knows this, every trader tries to follow this, but they don't really follow it in a very strict way. Let's go about this. Let's get into the mathematics of this, right? Risk to reward ratio, you must maintain a minimum risk to reward ratio of 1 is to 2. And we're going to get into this in detail. The second is correct position sizing. You should not risk more than 1% of your capital on any single trade, which again, Adam went over. The simple fact over here is that you lose small and you sustain yourself over a longer term time. Now, as a retail trader, I can stretch it up to 2%, meaning that I can have two open trades at any given time, each with a risk of 1%, which is acceptable. 1% is small, 2% is acceptable, but this is what you should do. Now, keep this in mind. This is something you must follow for every trade that you take. Let's get into a little bit of details, right? So, you could have, as a trader, a highly effective trading strategy. But if you do not implement these two golden rules, your account has little chance of growing, to be very honest. On the other hand, if I just follow these rules of risk management, I would grow my account regardless of whatever trading strategy I follow. And as I mentioned earlier, I joke about this in my class, in my courses. That if I have my rules of risk management in place, I can trade with the toss of a coin. Literally, I mean, heads I buy, tails I sell, and yet my account will grow. But then we are not here to gamble, right? We are here to trade. So, this is the importance of your risk management rules. Let me start off with rule number two, position sizing, because this is not what we are going to cover over here. So, I'm just going to briefly go into this. What we mentioned was risking a small percentage of the trading capital, which will enable you to sustain small losses while maintaining your account growth. We can correlate this directly to leverage. Now, high levels of leverage are available on all trading instruments, especially in the forex markets, but leverage can be or is a double edged sword. While the use of leverage can increase profitability, definitely, while the use of increased leverage can increase your profitability, it also puts your account at high risk. So, correct position size becomes very important. Now, this is a topic literally for another entire webinar. Position sizing, leverage, how do you control it, and maybe another time we will get into it. Before going into the risk to reward ratio, let me talk about the win loss ratio because this is something a lot of traders tend to concentrate on. Now, losing trades that we know are a part of trading and something that most traders find difficult to accept. Important point is that winning trades or losing trades cannot be controlled by the trader. Right? Once you take a trade, the market takes over and you cannot control the price movement. What you can control is your management of the ongoing trade. Obviously, every trader wants more winning trades, and thus they tend to concentrate on the win loss ratio. That I need a better win loss ratio for my account to grow. So it's a natural assumption, but this is not true. And we're going to get into the mathematics of this. So, rule number one, risk to reward ratio. As far as I'm concerned, it's a personal opinion, but it's a fact. And this is mathematics that I'm going to go into. It is a most important factor for your risk management. I define it as the thin line between success and failure. We are going to go into simple mathematics to understand this. Let's assume some calculations, all right? Let's say that I'm going to measure my performance over a basket of 10 trades. Now, this 10 trades, I may be taking 10 trades a month, I may be taking 10 trades a week, I may be taking 10 trades a day for all you know. I mean, it really doesn't matter. I'm just measuring the performance over 10 trades. Longer term trades are always better. I mean, I trade currencies mainly on the 4 hours, and I usually have roughly about 8 to 10 trades a month. That's what my trading frequency is. So let's assume that, taking my case, that I am trading about 10 trades a month. All right. Let's assume that we have a win loss ratio of 50%, which means that out of every 10 trades that I've taken, I have five losing trades and I have five winning trades. Now, believe me, a win loss ratio of 50% is a good win loss ratio. Most traders do not think about this and they want a higher win loss ratio. But do you know that professionals, traders, successful traders, even retail traders generally have a win loss ratio of roughly about 60 to 70%, which means out of every 10 trades, they will have three to four losing trades. You just cannot control that. You have to give that to the market. So 50% is, I would say, an excellent win loss ratio. We are going to take a good win loss ratio. Now, to calculate the risk, let's assume that we maintain a stop loss of 20 pips. Now, it could be 20 pips on any market that you're trading, could be 20 ticks, could be 20 points, could be anything. Let's just maintain this 20 ticks, right? So, let's start with scenario number one, that I'm following the rules of my risk management and I maintain a risk to reward ratio 1 is to 2 for every trade that I'm taking. So, for each of the 10 trades. So, if I have five losing trades, I'm going to lose 20 pips. Five trades, I lose 100 pips. If I have five winning trades, my risk to reward ratio 1 is to 2. That means every winning trade should have a profit of 40 pips, which means 40 pips into 5, I make 200 pips. Net result after 10 trades, I still grow my account by 100 pips. So you can achieve gain in the accounts while having five losing trades. This is a very simple, basic fact. Let's change this risk to reward ratio to 1 is to 1. Let's decrease it down, all right? Maintaining the same win loss ratio. As you can see, you lose five trades at 20 pips, you lose 100 pips. You win five trades at 20 pips, you win 100 pips. Net result after 10 trades is zero. Now, if in my case, if after 1 month I am not making any money and my account is not growing, I would say I'm simply wasting my time, literally. Right? I am not spending the whole month just not to make any progress. It all comes down to your risk management. Now, let's take this one step further. Let's bring this further down, the risk to reward ratio to 1 is to 0.5, which is what scalpers tend to do. Intraday traders, short term traders. So they would probably place a stop of 20 pips while looking for a profit of 10 pips, maybe even 5 pips. That you want to take small trades from the market and get out of the market. Let's look at the mathematics of this. If you have 5 losing trades at 20 pips, you're losing 100 pips. But if you have 5 winning trades at 10 pips, you're making only 50 pips. Your account is negative. Now, this is one of the reasons why I always say I'm not in favor of intraday trading. Smaller term time frames, there's just too much noise. Again, I'm going to repeat what Adam said over here. Trading long term makes a lot of difference. It has a lot of advantages. Most traders looking at the currency markets, it's a very natural thing that because the market is moving all the time, you want to take small profits, get out of the trade, and do that about 5 to 10 times a day. Let me give you a very funny incident I had with one of the traders who had come for a course in this, and he was a scalper, he was a short-term trader. He would get in and out of the markets. So his objective was to make about 5 pips or to 7 pips and get out of the trade. Fair enough. So I said, okay, that's a good strategy, but where do you keep a stop loss? He says, yes, I do keep a stop loss. I said, okay, where's your stop loss? He says, my stop loss is 100 pips away. I was like, okay, all right. So what is the reason for that? He says, market will never go all that way. I'll always get 5 or 7 pips out of the market before the market goes against me. It might go against me, but it'll come back. I'll take my 5 pips and I'll get out of the market. So my simple question to him was, have you really made money out of this? And then very sheepishly he admitted, no. Because the simple fact is that it's not if the market goes against you, it's when the market goes against you. And especially in currencies, in Forex, when prices tend to trend, if it goes against you, you realize one losing trade can wipe out 20 of your winning trades. And then where do you stand? Nowhere. So scalping, short term trading mathematically does not work. And I'm giving you simple facts, regardless of any market that you could be trading. Right. So now in all these three scenarios, what we did, we maintained the win loss ratio at 50%, but the results varied drastically.
100 every day. She says it's just impossible trying to.
I'm sorry, there's something? So we can conclude that your risk to reward ratio is more relevant than your win loss ratio. Now, to demonstrate this further, let's take another scenario now where let's reduce the win loss ratio to 40% instead of the standard 50% and keep the risk to reward ratio same as 1 is to 2 that we want to maintain, which means that I am achieving only 4 winning trades out of 10, 6 losing trades. Look at the calculation of it. 6 losing trades, I lose 120 pips. 4 winning trades, I make 160 pips. My account is still growing. So, which means if I maintain my risk to reward ratio, my win loss ratio is not important, even after having a larger number of losing trades. Now, this is one slide, which is not mine, to be honest. I picked it up from the web, but I kept it because it actually demonstrates this so well. On top is your win loss percentages, 20%, 30%, 40%, whatever. And on the left side column, you have your risk to reward ratios. And as you can see, your risk to reward ratios of 1 is to 1, you need 50% to break even. But if you have a risk to reward ratio of 1 is to 5, even with a win loss ratio of 20%, that means 2 winning trades out of 10, your accounts can still be profitable. Now let this sink in, completely let this really sink in, because this is crucial. If you follow this system, you do the mathematics, don't you think that your account can grow in spite of having winning losing trades? Losing trades are a part of parcel of trading, and you will have losing trades. There's no two ways about that. Right? So maintaining the minimum risk to reward ratio becomes absolute crucial factor. But let's get into practicalities now. Not every trading instrument or any time frame can give you this required risk to reward ratio. Ideally, the type of market that you trade, what kind of market that you trade, what time frame that you trade should be based only on this factor that you will achieve your risk to reward ratio. So let's take different scenarios over here. So there are different markets available, right? I'm a forex trader. I even trade futures, equities, commodities, etc. So everybody has a different approach to the market, different way. Now let's say that a trader has decided on an instrument that he or she is trading. Let's say I trade forex. I decide that I'm going to trade forex. The basic question always comes: what time frame should I be trading on? Now this is more or less decided by the trade. It's a very natural thing, decided by the comfort level or the convenience of the trader. Right. So if I can devote all working hours of the day, if I have all the time of the day, I can watch my charts, I can follow my trades, I can be a day trader. If I can devote a certain limited amount of time to the market, let's say I'm working somewhere, I have some kind of work, and I can devote some restricted time, I can be a swing trader where I can check my charts maybe 2, 3 times a day, if at all, maybe even more, but that's just about it. So this is what makes us as traders decide that what kind of trading we should do. But ideally, you should select that time frame and that instrument where you maintain or where you achieve your required risk to reward ratio. Now, this is important. Risk to reward ratio is dependent on the trading technique, right? You need to know your risk to reward ratio before you enter the trade, which means you must have a technique. Obviously, if you have a technique, you know where you enter the trade, you know what is your possible targets. Now, I'm saying expected targets. You cannot decide your stop loss or your target levels based on your comfort level. That I'm going to risk only $20 in this trade, or I need to make only $10 on this trade. The market respects technical levels, not your comfort levels, and these are determined by the parameters of your technique. Now, technique could be anything. Ideally, you must have a trade plan. Again, most of the speakers today mentioned a trade plan as a crucial part. You must have a trade plan where you have these factors in place before entering your trade. What are the setup conditions for your trade? Why am I going to enter the trade? What are the conditions? What is my stop entry and expected target levels? Are my rules of risk management being followed on this trade? What are the steps of trade management on this trade? Now, this becomes crucial. So, obviously, you need to be prepared. Obviously, you need to have a technique before. Now, this is something which I always tell my traders: to get into a trade, you must have a reason. If you are getting into a trade just because price is moving, or because somebody on CNN said that the dollar is going to go stronger, or you go visit some blog and somebody says that the Euro USD is a good buy, you are not going to succeed. You're more likely to fail. You must have your own system and you must have a reason for getting into a trade. Let's start with Forex again. So I'm going to start with a small 1 minute time frame. All right, on this 1 minute time frame, now what I'm doing in all of these trading examples, the charts that I've put, I'm using a technique of the divergence, because this primarily it's my trading technique, is my primary trading technique which I use, which I'm going to discuss in a little bit of detail over here. So all the techniques or all the charts are based on the technique of divergence, no other technique. Now, if you look at this, this was a bearish divergence and you did have price going down. But what was your risk to reward ratio? I have marked the stop, the entry, and the target. Risk to reward ratio in this was 1:1.6. Obviously, on a lower term time frame, the frequency of your movement is going to be lower. Now, to be very honest, let's say in a divergence, my targets are decided by Fibonacci levels. Now, this is going to be the same on whatever time frame that I trade on. So obviously, if the movement of the frequency of the divergence, let's say the movement of the divergence is smaller, my target level is also going to be smaller. So if I'm trading a smaller term time frame, mathematically, it's not giving me the risk to reward ratio, which is the main reason why I should not be trading on smaller term time frames. Let's take this on a 4-hour chart. Similar bearish divergence. As you can see, the frequency of your movement is much stronger in this. is much larger. Sorry, my mistake. It's much larger. Obviously, because the movements are more, and the biggest advantage of larger term time frames is that if price runs, if it tends to run, which it did in this particular trade, and I've put down this trade because this was traded in our trading room, you can achieve larger risk to reward ratios. Taking just the target one, you have a risk to reward ratio of 1 is to 5 on even on target one. I had a target two set over there, which gave a risk to reward ratio 1 is to 8. Price went further than that. We had a target three also in place that if it goes further, what should be the target be? We closed it at target three. That gave a risk to reward ratio 1 is to 10. Now, mathematically, if you take the three average, 1 is to 5, 1 is to 8, 1 is to 10, you are maintaining roughly a risk to reward ratio 1 is to 7, roughly, right? Which is much more than this 1 is to 2. But let's take just target one, right? If I just take target one and let's change this scenario that I achieve a risk to reward ratio 1 is to 5 on every trade that I'm doing, and my win loss ratio now is only 30%, that I'm making three winning trades out of 10. My seven losing trades, risk remains the same at 20 pips, is 140 pips, but my three winning trades, now each winning trade is giving me 100 pips, which makes it 300. So after losing seven trades, I can still make 160 pips. Now this is important. Higher the time frame that one trades on, larger will be your risk to reward ratio. You can achieve higher RR ratios because prices tend to trend, and this is true on any market that you trade, not only in Forex. Plus, the simple fact is, if you trade on larger term time frames, it gives you enough time to plan your trades. You're not entering a trade in a knee-jerk reaction, right? On a 1 minute price starts moving, you want to get into a trade. 4 hours higher time frames give you enough time to plan your trades. And the simple fact is that institutes, big money, banks, they trade on higher term time frames. Right? Do you think they trade on a 5 minute and a 1 minute time frame? They do not. They hold their positions for longer term time frames. Obviously, they would want to trade on larger term time frames. So you want to trade where the big money is, right? So trading higher term time frames brings a lot of advantages to it. Let's take futures. I'm taking different markets. I've taken the crude oil over here, one of the most volatile trading instrument. We still trade this, and most traders tend to trade crude on smaller term time frames. I've taken a 1 minute chart over here. They even trade on tick charts. That's because the volatility is there, the movement is there. So even on a 1 minute time frame, as you can see, you can achieve a risk to reward ratio of 1 is to 3 on the same divergence technique. This is a bullish divergence. The price frequency can be slightly larger than what you will achieve on the 1 minute in a Forex market. So futures, yes, you can trade on smaller term time frame. Let's take this on indexes, right? On indices, now the NASDAQ. I've taken this NASDAQ a 15-minute time frame because there was a great divergence just a couple of weeks back. This is a bearish divergence. As you can see, I've marked what is your entry, what should have been the stop, what should have been the target. You are achieving a risk to reward ratio of almost 1 is to 3 right over here. So this is your risk to reward ratio. So even on indexes, NASDAQ, it works. Let's take this further on equity markets. Now, this is an actual trade, all right? This is a weekly time frame on a stock, which is a Wells Fargo and Company. I do some consultancy work for some hedge funds, and this is a trade call that I had given them about in the month of Jan, almost about 6 months back. Now, this chart is in the month of January, all right? This was the entry I've marked over here. This is a stop. This is target 1. This is target 2. And today, the chart is right here. This is a weekly chart. So you can see the number of bars is probably taken about 6 odd months to reach over there. It's reached your target 1. It's gone beyond. We are still waiting for it to go to target 2. The fund is still holding on to it in the hope that maybe in the next 3 or 4 months, it'll still go to target 2. But what's more important over here is your risk to reward ratios. Again, even on swing trading, you're still maintaining on target 1 is to 3. So this is your importance on different markets. So your risk to reward ratio should define your time frame. Maintaining 1 is to 2 is crucial. and you must select the time frame that will offer this. Obviously, trading on larger term time frames is advantageous. You can capture larger moves. If you increase your risk to reward ratio, you can afford more losing trades. It's as simple as that. There's a simple mathematics to it. But if you decide to trade on smaller term time frames, my advice has always been ensure that the quantum of the price movement fulfills this minimum risk to reward ratio 1 is to 2. Only then your account will grow. Whatever instrument you select, whatever time frame you select, if you are not getting a risk to reward ratio 1 is to 2, my advice is do not trade it, because you're just wasting your time. You're literally donating money to the market. All right. Now, going over, this was the money part. Let's go over the other important parts. So this is your mind factor. I'm not going to go over this too much because I'm running out of time. So mind factor for me is just discipline and patience. On my website, I have a saying: trading requires the discipline of a soldier and the patience of a saint. And it's actually a fact. Your psychology of trading, it's human nature. You must learn how to accept losses. You must maintain a stop loss. You must stop hoping for a trade to come back. You should not do revenge trading. These are the things which have to be built up. It is important. Like I had mentioned, it's more important than your method. All right. But again, this is a topic for another webinar by itself. The method, your trading system. Follow a system which is effective and which is easy to follow. Right. So I'm going to go over the divergence because, like I said, it's a primary trading technique. Now, this is based on the concept that institutional traders create traps for retail traders. The simple fact is retail traders are stopped out because institutional traders know exactly what a retail trader is going to do, and they have the capacity to move the markets. So they will create these traps, which is what a divergence is all about. Now, even in divergences, there are different types of divergences. There is a class A divergence, there is a class B, and there's a class C. We trade only the class A because it is the most effective one. So this is a slide, right, of what a divergence really is. So you have a support level, price bounces off a support level, it goes up, it comes back to the support level. Most retail traders will tend to buy over here, saying that it's a good support level, and they would obviously keep their stops below the support level. And as you can see in this image, graphically captured over here, retail traders will drive, I'm sorry, institutional traders will drive price down. You can see that wick over there, and take out all the stop loss orders, and then your actual trend starts. Now, this is what creates a divergence, which is why it is one of the most effective techniques that I've come across. And this is something which I follow all of the time. Let me go over trading situations, right? Different currencies, different markets. So this is a divergence on one of the 1 hour time frame. As you can see, the divergence over here, this was an actual trade because this was a anticipatory order, a buy stop order. So if price moves up, I get filled into the trade. As you can see here, if price does not move up, I don't get into the trade. I had my entry, I had my stop, and I had my target fixed. These are all based on the Fibonacci levels and the different levels that we follow. And look what happened to the trade. Went right up, bang on. It stopped bang at that Fibonacci level and some other levels of support resistance that we try to confluence it with, and turn from there. Excellent trade. This is a divergence on, I'm sorry, this is an equity, again, on an Australian company. Remember, yeah, it's Newcrest Mining. I'm sorry, I was just confused. What chart was this? But the same thing, divergence. It worked. I had my stop, my entry, and my target in place. So this was the trade that I could give out, saying that this is what it is, and price stopped exactly at that level. Right. So this is what your methods should be. So your 3Ms, very important, folks. Coming back to follow the concept of 3Ms, follow the correct rules of risk management, follow the techniques correctly, have a reason to get into a trade, and it's not difficult to be successful. I know traders who have done it. I have done it. I know people who can, and so can you. Right. So just a quick, I conduct these divergence courses regularly with advanced Fibonacci ratios. I'm having one coming up on next Saturday, which is 31st of July. For any further information, please visit my website, FibForex123. In the events, you'll find everything. These are my contact details. I'm on LinkedIn, I'm on Twitter. I have a YouTube channel. So if you have these slides, just go to my YouTube channel. You'll find a lot of good videos over there, practical videos. Maybe a little long, but I do give out information which is practical. Lastly, this is my email address, sunil at fibforex123.com. Please feel free to send any kind of question that you have. I always answer questions. I like to interact with traders. It has been my intention to help traders. All right. Get practical information and give practical information. Any question you have, since we are running out of time over here, please let me know. Send me an email. I'll be happy to reply. I'll be happy to see you for the courses. I'm more than happy to help traders because from my experience, I have seen, I have lost a lot of money. I see traders losing a lot of money by following the wrong concepts. I want to put down the correct concepts. That's more important for me. Rick, this is, well, let me give you a James Bond dialogue over here. The difference between a class A and the other divergences, well, I can tell you, but then I'll have to kill you. This is part of our courses, all right? It's obviously, I mean, it's not in public domain. It is important. It's a difference. I would appreciate if you could come to my courses and you would know the difference. The simple fact is that I cannot really explain it over here. If there was a way to give you a brief idea, I would have, but I really cannot. All right, folks. Okay, I'm 1 minute short on my time. All right, so that was it. Any questions? Please let me know. Send me an email. I'll be more than happy to answer.
Sunil, thank you so much.
All right.
I'm so sorry it was difficult for us to get started. And as always, we don't have enough time for you, and we will do this again. I think we'll do this again, and I'll have to review our platforms things. But for the meantime, thanks very much indeed. Take care, and we will speak again soon.
I'll speak to you again soon, Simon.
I will
Thank
ask
you,
for the
everybody.
slides.
Thank you, Simon. Great being here. See you, folks.
Okay, thank you so much, Sunil Mangwani, Fib4x123.com. Okay, folks, so sorry about all these technical hiccups we've had, but thank you for staying with us. We are actually at our final speaker, George Halmy, who will be waiting for us, I think, on the other side. So we're going to close this session, open up our final session 7, and see if we can bring George in without too much trouble. See you in a second.
Mm-hmm.